The oil ETF went well as the energy crunch helped the exchange-traded fund, ETF, outperform all other investments. Exchange-traded funds that track crude oil futures have been the top performers this year compared to other financial instruments, most of them returning over 40% since January, as a supply crunch kept spot prices ahead of futures. Investors have sold and took profit on the 2 crude oil ETFs in Hong Kong and 4 in mainland China with $430 million in combined assets, riding on this year's rebound in oil prices that reached 7-year highs several times. ETF managers gained handsomely this year from backwardation. The market condition where oil futures trade below the expected spot price in a downward sloping futures curve. They would roll their futures exposure forward, pocketing the spread as returns for their fund. Unlike stocks, futures contracts expire, requiring them to be rolled over to keep the fund running. Under backwardation, it is more expensive to buy crude oil today for immediate delivery than crude oil that will be delivered several months out, said Victor Chung, a director and ETF product specialist at Mirae Asset Global Investment. We believe the high spot price was reflecting stronger than expected demand due to economic recovery and supply shock. Spot crude oil prices have risen 44% this year to $69 and 49 cents per barrel in Cushing, Oklahoma, boosted by a sharp uptick in global demand as the world economy recovers from the COVID-19 pandemic. West Texas Intermediate futures for December delivery rose 75% for the year to October to $83 and 42 cents a barrel, the highest since 2014. Some analysts expect oil prices to go even higher. JPMorgan raised its 2022 oil price forecast in late November to $125 per barrel and $150 per barrel in 2023. The spread of the new COVID-19 variant Omicron in late November has halted the recent gains in oil prices. Mirae's 68.6 million Hong Kong dollars global XSP crude oil futures ETF returned investors 48.6% this year, while the Samsung GSCI crude oil futures ETF, at 1.3 billion Hong Kong dollars, returned 52%, making them the 2 top performers out of 100 funds traded in Hong Kong, according to Morningstar. By comparison, Mirae's Global ex-China electric vehicle and battery ETF returned 45.9% in the top spot among equity-linked funds. Returns of the 4 listed funds trading on the Shanghai and Shenzhen exchanges are equally strong. These 4 funds, such as the 244 million yuan crude oil fund managed by Fund Asset Management, and the 732 million yuan Southern Crude Oil Fund managed by China's Southern Asset Management, invest in offshore ETFs. The 2 funds ranked as the top 6th and 7th fund this year among the over 360 China domiciled funds that invest into offshore securities tracked by Morningstar. Unlike mutual funds whose trading is limited to once per day, investors in an ETF can buy and sell the fund's unit on exchange anytime during trading hours on the local exchange, making profit-taking easier for investors, said Carmen Chung, head of ETF and passive investment at Samsung Asset Management. ETFs provide real-time liquidity that enable one to buy and sell at discretion, said Chung. The outflow could be attributed to oil price trading at a higher level compared to a year ago, and this incentivizes investors to lock in profit. All managers are bullish on oil. CSOP Asset Management, the Hong Kong subsidiary of Southern Asset Management, launched its first inverse oil ETF product on the Hong Kong Stock Exchange this month. The inverse ETF seeks to deliver returns when oil price drops, losing out when oil gains. Last year's unprecedented and surprise plunge below zero of WTI crude oil contracts when May contracts changed hands at -$40 and 32 cents on April 20th served as a recent example of how oil prices still face unprecedented uncertainties due to repeated COVID-19 outbreaks, said Wang Yi, head of quantitative investment at CSOP Asset Management. The commodity super cycle is boosted by the major central bank stimulation, which drives global demand, Wang said. With more central banks exiting stimulation measures, we are facing a more challenging and complicated recovery from COVID-19.